stock markets take a breather after yesterday's literal fireworks as Iran strikes Israel and the markets panic. But we are once again facing a busy macroeconomic calendar with data on the hopper tomorrow and, of course, on Friday that might bring us back to volatility. I'm Ilya Spivak, head of global macro here at tastylive, and this is Macro Money. We're going to unpack all of that here. We spent yesterday in the wake of Iran's attack talking about how that might extend into the release of the ISM report, which comes to us tomorrow. Today, we're going to take a look further afield and see how all of this fits with what is probably the biggest piece of event risk for the week, September's U.S. jobs report. So, as ever, the question for us, not so much the academics of the situation, whether this or that definition of jobs growth or the unemployment rate or this or that is real or not real or well-founded or not well-founded. As ever, our question is about the market's reaction function. That is to say, if we were to get good or bad data, would stocks like or not like it? And so with that, let's consider where we stand and just do a bit of inventory about what's actually occurring here. So we know that the markets concluded in early July when the Fed began to signal that it's ready to cut rates, that they felt the Fed was behind the curve. And this much is readily on display when we take a look here at where the July top is in the S&P. We can see very clearly here that what happens is into that July top, you are looking at a building of Fed rate cut expectations for 2025. That's the yellow area that you see there, even as the outlook for this year, for 2024, in the gray there, is holding static. Now, why is this occurring, and why is it that when the Fed actually starts to talk about needing to cut, which occurs right here as Fed Chair Powell testifies in Congress to this effect, why is it that this is a downturn, and why is it that going in here, all these rate cuts are building out? You can see the overall tally of cuts is growing from here, where it bottoms at negative 76 basis points. It nearly doubles to the start of July, where this actually occurs. So why is that? Well, look at the way that economic data was performing. And we can see that from mid-April and into early July, where the Fed makes its announcement and very clearly bottom takes this, which we'll get to in just a sec. In just a second here, the Fed says right around here that it's prepared to go. Notice what U.S. economic data is doing in this period. This is a Citigroup index that measures its performance relative to expectations. It's deteriorating, and as of early May, it's actually tending to undershoot relative to baseline forecasts. So the message that the markets are receiving is that the economy is doing less well than expected. So not surprisingly here, the markets say, well, until this point, the Fed is reluctant to cut. It's worried that deflation isn't happening fast enough. So the markets say, well, that means more cuts next year because you're going to realize that you're late, because the economic data is already deteriorating. So when the Fed actually makes this statement here and and gets the conversation going and focused on rate cuts being not just some future thing, but imminent, at that stage, the markets go, well, you've finally found the weakness we've been looking at for 3 months. And ostensibly, you've recognized something that is so ominous that you've been compelled to act. And that's not good news for growth. And so what you see here is stocks come off as things get more dovish. Now, fast forward, and what you find is that some of those fears about the strength of the US economy and the motivations then for the Fed to do what it was doing at that stage, that's turned out much more well supported. We just looked at this a moment ago. Notice since July, there's been some anchoring in the way that data has performed relative to forecasts. And then late August into September, the data actually starts to get on the mend. So much so that now it's actually crossed back over the zero line, suggesting that for the first time in 5 months, U.S. economic data is tending, or has now a tendency, to beat forecasts as opposed to undershoot them. This is a very different sort of environment. Now, notice here, if the markets were going to be concerned that the Fed is scrambling because they've already missed the window, this is not that narrative. This is a narrative of a U.S. economy that's looking stronger than anticipated. We see this in the latest batch of PMI numbers from S&P Global. Notice here, we've been basically holding at the high from May on this composite index. And of course, as ever, this is done in the logic of PMIs. So above 50 is growth. Below 50 is contraction. The further you go above 50, the faster the growth. The further you go below 50, the faster the contraction. And what you find here is that you had a jump in U.S. economic growth back in May. That's here. And then for the subsequent 4 months, September included, you've held those levels. And that's because the service sector, the largest part of the economy, has shown up more robust and offset weakness in the manufacturing side. Just earlier this week, you began to start seeing the ISM version of the same kind of PMI data. This is from the Institute of Supply Management. So far, we've had the manufacturing numbers out. Here is the forecast for the service sector numbers due tomorrow. Now, we can see here the manufacturing side was a little bit lighter than expected, ever so slightly, 47.2 versus ultimately the consensus forecast at 47.5. But this is holding generally steady. And as we discussed on the show yesterday, the internals of this report actually looked quite positive. We saw the first decline in prices in a year, or this year. The last time we saw a decline in the price index was December of last year. We saw welcome signs in lengthening delivery times, in falling inventories, in the production index almost coming back to growth, in new orders falling at a slower rate. All of that seemingly suggesting that the under the surface dynamics below this number are generally starting to look a little bit better, even though at the surface you're basically holding steady. But weakness in manufacturing need not be a problem for the overall story here, at least from the Fed's perspective, because of course they're judging this at a very high macroeconomic economy-wide level, because as we just saw here, we had the deteriorating manufacturing from S&P Global. It was much more dramatic than what we're seeing here, where things are basically steady. But as long as services is going to be strong enough, the overall growth rate holds up. Services, of course, accounts for between 70 and 80% of the economy. So when we look for what's likely to happen here with the service sector index, as long as we get somewhere within the realm of expectations, much as we did with the manufacturing side, we again get a story of an economy that's steady. And again, looking back here, this is what steady means. Steady at solid levels. It would be much the same sort of conclusion here were you to land, give or take, as anticipated. At the same time, the Atlanta Fed's closely watched GDP forecast, although it's ticked a bit lower to 2.5%, still well above where consensus expectations are, and still looking at reasonably strong numbers. So we're still looking here at a situation where, despite the fact that we've downticked from 3 to 2.5%, if this is going to be right, then we will have grown 2.5% in the third quarter after a 3% gain, stronger than expected, in the second. That's not bad news. That's good news. That's relatively healthy. And of course, the markets have reasoned that we are going, against this backdrop, to be adding stimulus on top of an economy that is not doing poorly. And of course, what that means is that we are, in essence, looking at a situation where if the economy were shy of demand and the stimulus, that is rate cuts from the Fed, if that were to be something that was looking to counteract some sort of weakness, then we'd be looking at a story of relative positivity and a story of inflation coming up from low levels. That is not what the markets are saying. They're saying what these rate cuts that the Fed has now initiated going to do is stoke reflation and give us once again something that might limit the Fed's appetite for rate cuts. And you find this very clearly here in what we've seen over the course of September, as the Fed really started to signal that the move in last month's policy announcement will be to do the jumbo 50 basis point cut, which of course they ultimately delivered on. We see gold higher. We see the spread between the 10 and 2-year yield, the slope of the yield curve, steepen because long rates rise, even as the markets position themselves for a more aggressive Fed, because this is being viewed as reflationary. The expectation is, well, this will make for a need to have higher rates in the future. We see that the 5-year, the 10-year break-even rates here are at the highest that we've seen them since back in June. So all of this seemingly speaks to higher inflationary pressure. And then, of course, we posit that alongside now expectations that the Fed is going to cut by a further 50 basis points this year, once in November, once in December, ostensibly, and then another 115 basis points are baked in for next year. That's about 4 cuts and a 50-50 shot at a fifth, and ask ourselves, well, if the economy is doing strong, if we are looking at the markets endorsing that and saying, well, this will be reflationary then, given how much easing the Fed is now expected to do, if we were to get data suggesting that indeed there is a disconnect, well, then the amount of easing that the markets expect might be diluted. In fact, you already see a little bit of that starting to happen. And of course, you already see a little bit of weak need dynamics from the stock market against that backdrop. Now, of course, geopolitics is a part of that decline as well, and we'll take a look at it in just a second. But nevertheless, the creep is starting to occur. And if indeed this is now the way of things, and U.S. economic data has scope to beat relative to forecasts, then our expectations for what this U.S. jobs report that we have coming up on Friday, the expectations for what that is going to give us here, those might be a little bit light relative to what is actually liable to occur. Now, let's take a look at what those expectations are and consider where the markets are biased. And what we find, of course, is much as we did with the PMIs, much as we did with the ISM numbers, relatively steady conditions. Here is jobs growth expected at 145,000 non-farm payrolls rise. That's a barely noticeable uptick from the 142 recorded in August. Jobless rate seen holding unchanged at 4.2%. So steady as it goes here. But again, if this is now the way that things are going to trend, then there's upside risk here. And if there's upside surprise risk, well, then we may well see this move further upward. And of course, the operative question therefrom is, what does this mean for stock markets? Now, we already had a bit of upside surprise on this data this week. Job openings numbers higher than expected. 8 million versus 7.6 million, or 7.67 if we round it. If we round it, expected. The ADP measure of payrolls growth. This is a private sector estimate. 143,000 jobs added in September, according to their numbers, versus 120,000 expected. So there's already some signs that jobs data is outperforming forecasts. If that's what we end up seeing here, and these numbers register higher, this may well shift into a still less dovish setting, because this starts to look still more reflationary. And now the question, does this pose a risk for stock markets? Should this be something that we are concerned about? And here, the main sort of consideration, as you might anticipate, comes from sort of relative positioning. It isn't so much that it is bad news that the economy would be adding more jobs than expected. That's certainly not the case. It is more a question of whether the markets are prepared to take incremental further exposure on risky assets on that basis, and whether that is something that is going to be an upside motivator or a downside motivator, not so much for the economy, but for risk taking. With that in mind, it is important to consider, as we have earlier this week, when Fed Chair Jerome Powell came out and said pretty much this to the markets and said, we don't need to go fast on rate cuts. We're facing a dual risk, not a singular risk just to the jobless market now. We're not singularly focused on labor conditions the way we were singularly focused on inflation from 2021, 2022 through basically to the middle of this year. No, we are looking at a balanced set of risks where we don't want to let inflation reaccelerate, and we don't want any further pain to labor market conditions. So we are cutting, but by no means are we in a hurry. And of course, he asserted loudly, as a matter of fact, that the Fed doesn't think that they're late. They don't think they've fallen behind the curve. And when those comments came around, stocks didn't like it. Now, one reason why that might be is, as we've talked about earlier this week, this is a chart from The Economist, courtesy of data from the IMF. We find that this rate hike cycle has been unique relative to every single other one since basically the advent of the modern financial system, when the dollar depegged from gold in the early 1970s. Take a look at this chart. This represents the change in the Fed funds rate. So this is rate hikes. And then this is the change in interest payments made by non-financial firms, so non-banks. In other words, this says when the Fed hikes rates, companies have to pay more to service debts because rates are higher, the cost of money is higher. That's what slows the economy. That's what brings down inflation. This is why rate hike cycles tend to be accompanied by some degree of economic weakness. Notice how this current rate hike cycle vastly differentiates from every other one. Whereas payments on interest by the private sector increased in every other instance, or at least stayed steady. In this case, they actually fell. Now, how is that possible? Well, we had rates very, very low and lots of non-traditional stimulus like open-ended QE in the wake of COVID. At the same time, the global economy was shuttered. So companies didn't really have a whole lot of money to spend, relatively speaking, with everything offline, but lots of opportunity to borrow for next to nothing. And so the cash reserves that they've built up were substantial. That's how you now end up with a situation where even though rates have gone up, interest outlays have gone down, because companies are flush with hoarded cash after the pandemic. But those loans tend to have a refinancing window of 3 to 5 years, which should bring us to right about now. If the cost of capital starts to reset on these loans as we go into next year, that would be about a 5-year window, then even as the Fed cuts rates, companies are facing higher borrowing costs. The Fed would need to essentially cut back all the way to zero for that not to be the case, even as it's cutting, because, of course, the rates that were available in the heart of the COVID pandemic were essentially free money. And we are very much not there, even if the Fed cuts twice the amount currently expected next year. So what we have here is a palpable concern that as these refinancings occur, if the Fed were to cut less, they would present a greater risk. And perhaps that is why the markets are looking at the rate cut tally and saying, we prefer more versus less. So if this data is going to surprise higher, as has been increasingly the case, then the S&P 500 here might get a little bit soft, just as it tests support at about 57.21, having pulled back off the high just above the 5,800 level. And if we can push through here, and then also the highs that we see here going back to August at 56.65, well, then this is going to look not like a pullback, but like capitulation and a reversal downward. And that is macro money for today. As ever, we are here every Monday through Thursday, right after overtime, a show that I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things are likely to go therefrom. I am on every Wednesday with Victor Jones for the Price of Truth. That includes today, certainly. So come check us out. Back on with Chris for Futures Power Hour on Fridays. On with Victor and Tom for First Call on Sundays. Writing for the News and Insights portion of tastylive.com. And commenting on the platform formerly known as Twitter at Ilya Spivak. Thanks very much for joining. See you soon.